What happens when you use personal debt to finance a small business? Sometimes it's a mess. Ted is here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. Let's get to it. I'm going to start with a quick question. You can give a quick answer or a long answer. It's up to you.
No.
Why? You got to let me ask the question first.
Oh, okay. Sorry.
Why do people become self-employed, or why would someone start their own business?
Historically, it used to be because they thought that they could build a better mousetrap so they could make more money than being an employee. More recently, it's they don't have any choice. There is no job for them in the old world economy. They have to create a job for themselves.
Yes, so I agree with you. I mean, we started this business, Hoyes, Michael, and how do you pronounce your name? Michaelis? Hoyes, Michaelis and Associates.
We were using abacuses,
yes,
a little medicine.
Well, we had a typewriter.
We did.
In the
First
head office, which was our only office at the time. And we did it because, we can do better than what the other guys are doing.
Right.
It was a proactive thing.
We were lucky.
Yes.
In that we were correct.
Yes, we were correct. And all of our former employers, I believe, are no longer in this business. So we made the right choice. Mm-hmm. But I agree that for a lot of people, it's like, well, I got laid off.
Right.
And I can't find a job somewhere else. So I guess I better just start my own.
I have to do something.
Now, I'm going to put a link in the show notes to episode 524 called Starting or Buying a Business to Earn an Income Out of Necessity. Kind of what you're talking about. That's a podcast I did with David Barnett. We go through in a lot more detail on that. So if you're watching this on YouTube or whatever platform you're on, you can go to the show notes and see the links to not only that episode, but a few others we did as well. So let's talk money.
Okay.
That's what this show is about. How much money do you need to start a business?
Well, so you're going to have to answer a question for me. Is the new business capital intensive? Do you need to buy a lot of stuff, equipment, inventory? Do you have to have things to provide the business a service, or you don't really need much of anything?
So let's talk about examples of that then. So a capital intensive business would be, let's talk about landscaping.
Sure, because everybody thinks they can do that. I got a pickup truck and a lawnmower.
So if like I remember when I was a kid, I would cut people's lawns and I would just use their lawnmower.
Right.
So I'd push the lawnmower, they'd pay me. So that required zero capital. I guess I needed a pair of boots or something.
Probably. You still have all your toes?
I do, yes. So I wore steel toes all the time. So, but if I want to be a landscape construction guy.
Right. So if you want to be putting armor stone and trees and all sorts of landscaping around new construction or repairs, that's capital intensive. Or at the very least, you're going to be leasing or renting equipment to do these jobs.
Which also requires money. So I need a bobcat and a tractor and a thing that does
more
the
than
digging
a pickup truck.
And a whole bunch of stuff. A trailer to haul all this stuff around. So, okay, so why are we talking about capital intensive versus not capital intensive? Like what?
Well, so the premise of all this was people using personal debt to finance a business. Well, usually when you start a small business like a landscape, well, okay, I need a pickup truck and a lawnmower. I can just use my credit card to carry the business through while I'm doing things. But the second tier that we were talking about, where you need an excavator, a bobcat, a trailer, all of this other equipment and tools, you've got to buy or lease those things from somebody up front, which means you've got to have access to money to do it. Most people don't have savings for this because we're talking about folks who were forced into creating a job, so it goes on their credit.
So I want to start this landscaping business. I go to the bank and I say, hey, will you lend me $1 million?
Right. And we'll say, have you got $2 million of equity in your house?
And that's the problem.
Right.
You cannot raise the capital when you don't have any capital.
Well, and there's a second tier to this. Well, we'll probably get to this later. So even if you have the money to open the business and get all of this equipment, do you have enough capital to fund the period of time it's going to take you to generate profits? So you can maybe pay the bills every month, but that doesn't mean you're going to have enough money left over to pay yourself. So again, you're relying on your personal credit while you build this business.
So when you say build the business, I'm just going to open it up and start making money.
Right. And magically tomorrow, everyone will show up at your door and say, I need Doug to do my landscaping.
That's how I'm going to do it. But that's not how it works in real life.
Generally never.
So, okay, back to my landscaping business here.
Okay.
So I've got to get the customers.
Right.
So on day one, I mean, maybe I was working for somebody else and I can steal a couple of customers.
Maybe.
But
or maybe your family's got extensive real estate holdings and they're willing to hire you.
Yes, that's what it is. My family has extensive real estate holdings.
Your name Trump?
No. We have no real estate actually. So what I'm going to have to do is, I guess, knock on doors or do Google Ads or something.
Yeah. The old days of, you leave a flyer in their doorstep with a newspaper. Doesn't work anymore because there aren't any newspapers.
Right. And nobody, you stay away from my house kind of thing.
That's right.
So it takes me a while to get the customers, and then the customer isn't necessarily paying me immediately either.
Right. Lots of companies, we call it off-balance sheet financing. You get a bill, you deliberately don't pay it for 30, 60, 90 days. You don't have to borrow for the bank to get that credit because, you've already got the service.
So in my landscaping business, I come and I cut your lawn every week. And at the end of the month, I send you a bill, and it takes you maybe a few weeks to send me the check or do an e-transfer or however it works.
Right.
So there's 2 months there where I had to either pay myself or pay my guys or put gas in the lawnmower or something.
Somebody had to finance operations.
So there's two issues then. Number one, the stuff you need up front.
Yeah. You need cash to get started.
And then you need operating cash.
You need cash to keep operating.
And you can't get that cash from the bank.
Banks only lend money to people that don't need to borrow.
There you go. This is the key key to life. So
it's the key to running a bank.
Yeah, that's it. So because they want a guarantor, they want what's your equity? How long has the business been in business? So therefore, like you said, your only choice then is you got to fund it yourself.
Right.
And how do you fund it when you have no money? Well, it's your credit card. It's a loan. It's like whatever you can scrape
wherever it
together.
comes from. Yeah. I mean, the second tier of that is you borrow from family and friends, which gets even worse because now you're using their credit.
Yeah. So let's talk about then the pros and cons of using personal credit to finance your business. So, and I'm going to give you my thoughts and you just sort of to tell me, because of course, neither one of us have looked at the script before we started recording here today.
Didn't you write it?
Yeah, but like a couple of weeks ago. So, so here is the pro number one as to why you would use your own money to do it. And the answer is, well, you've got it. Like it's easier access to credit, right?
So you've already got credit history. You've already got credit that you've access to yourself. The new business isn't going to qualify.
Right. And maybe I already have collateral. So explain what that fancy word
So
means.
Collateral just means that when you borrow from someone, we'll call it a bank, you tell them that if you don't pay them back, they can come and take something away from you.
So what kind of collateral would somebody have who's starting their own business?
Yeah. So typical collateral would be equity in your house. Or you want the money so that you can buy a piece of equipment. But you didn't get a loan for the equipment, so now you could use the equipment as saying, if you don't pay me, you can take it.
So you go to the bank and you say, I want to buy that truck.
It's some physical thing.
Yeah, I mean, a truck is easy because there's lots of people who finance trucks. But if I need to buy one of those riding lawnmower things or a excavator or something like that, well, probably the company that sells those has access to some kind of financing plan as well.
That's right.
Now, that doesn't work. So that's capital, okay. But then there's the operating.
Right. So if
no collateral for operating.
You do work for a customer and they're not going to pay you for 2 weeks. Well, the guys that did the work for you need to get paid Friday or they can't pay the rent. They'll go work for somebody else. So you've got to have access to money quickly.
So I can go to the bank and say, I want to buy a truck. And they go, okay, we do truck financing, no problem. I mean, provide you get good credit and all the rest of it.
Right.
But it's very difficult to go to the bank and say, I want to finance accounts receivable. Right. Which is the money that my customers are going to be paying me over the next few months.
Well, and the banks aren't likely to do that, but you'll find somebody that does. They call it factoring, and you won't like the interest rates they charge.
Yeah, and even factoring, well, there's nothing to factor until I've done the job.
Right.
So
they won't factor small dollar jobs anyway.
No, they want huge dollars. So I'm cutting your lawn every week. At the end of the month, I'm going to issue you a bill. Well, I haven't issued the bill till the end of the month. Right. So there wouldn't be anything to loan against, even if I could find someone to loan against.
True.
So, okay. So the first reason that it's a good idea to, do this yourself is you've got easier access to credit. If you've already got a line of credit on your house, you've got a credit card, you don't need to apply for it. It's already there.
Just tap into it.
The second good thing about doing it yourself is potentially lower cost.
It's true.
So because your HELOC on your house.
Definitely lower than just a personal line of credit because you've got it collateralized, secured against your house.
And if I go to the bank with no security, well, then obviously, even if they do the deal, the interest rate is higher.
Right.
The other, I guess, thing is if I'm using my personal credit card for this, well, I guess I'm getting the points and the rewards, and all that kind of
cashbacks
stuff.
or airline reports or whatever it is that they're giving away this week.
So, okay, I guess that's a good thing then. So, unless you're not paying your credit card bill, then
well, you still get the points.
Yeah, small consolation, but yes. So, okay, so if you have to finance a small business, it's easier to use your own money, and if you have decent collateral, the loan rates are cheaper.
Right.
Well, that's all for the pros.
Yeah.
Let's talk about the cons now.
Yeah, it's not a long list.
Well, what's the most obvious thing on the list then?
Right. Well, you've got to pay the debt back.
Yeah, this is the problem.
It's not the business that's borrowed this money. You've borrowed this money, or the business borrowed it and you guaranteed it. So now it's your money. If you can't pay it back, they're coming after you.
So you are personally liable for this.
Correct.
And this is something people don't grasp because they say, no, Ted, you got it wrong.
I got a business Visa card.
Exactly.
I got a business loan.
Well, and I started a corporation, Doug Corp, and I went to the bank and I said, I would like a credit card for Doug Corp. And they say, here you go. Here's a credit card.
By the way, sign here too.
So I'm signing as the corp, but I'm also signing as Doug.
Personal guarantees.
And is that common?
Very common particularly for new businesses or smaller businesses.
It's kind of because the bank's going like, your corporation started 3 weeks ago.
You know what? The best way for you to think about this, when you're asked to personally guarantee a business debt, you're a cosigner. So you may have been to the bank and they said, well, we won't loan you money for that car because you haven't been working long enough, but if you get a cosigner, we'll do it. Well, same thing applies to a business when you guarantee it. They're giving the business the loan, but they're saying, no, you, Ted, are personally guaranteeing that the business is going to pay us back.
And what makes it a little bit bizarre is you're guaranteeing yourself.
Correct.
As opposed to I'm co-signing for my kid or my next door neighbor or my spouse or something. No, I'm co-signing for myself.
What the bank is basically doing is saying, look, we're taking the risk, so you have to assume even more risk. You're guaranteeing us that this doesn't work. You're going to find a way to pay us back.
And that's pretty risky.
It's very risky, depending on the nature of the business that you're starting.
So you got to really understand that. So, okay. So the first problem with financing it yourself is you're on the hook for everything.
Right.
Unless
it's do or die.
It's do or die. Exactly. I mean, maybe it's possible in your corporation to lease a vehicle, and when you give the vehicle back, they're fully collateralized or something. But even that is highly unlikely.
Right.
So you're taking a massive amount of risk. The second problem I see with all of this is blurred finances.
Certainly.
Everything is commingled.
And then there are two aspects to this. The first is you don't actually understand that there's a difference between you and the business. And so, as you say, it's commingled. It's all just one mess. The second is you deliberately start kiting things between one and the other. You're playing games with it, which is even riskier.
And why is that riskier? I mean, I can see a couple of problems. Number one, I got a tax issue here.
Right. And you might have two tax issues, right? So if you're lending money to the company, then you can't claim that as any kind of deduction for you unless you've got interest on your credit cards that you can show it's being deducted. If the company's lending money back to you because you've got stuff to pay off, then there's a tax implication. So it gets complicated very quickly.
So let's skip ahead to the practical advice section because we're going to get to it eventually. Obviously, the practical advice is, well, don't blur your finances.
Right. Keep things very distinct and very clear. So if you're going to use personal debt to finance this new business, all right, so then my Visa card is only for the business. I'm not going to use it for anything else anymore. If it's a personal line of credit, okay, stop putting any personal charges through there. It's all for the business. Maintain separate bank accounts for everything. Keep it all very clear.
And
hard to do.
Yes, it's hard to do. And you and I are biased because we're both chartered accountants and CPAs.
So we like numbers.
Yeah, and well, we all think if you're starting a business, you should, before you start the business, talk to an accountant and talk to a lawyer. Mm-hmm. And because should you incorporate or not?
And if you can only afford one, talk to the accountant.
Yes, because you don't have to incorporate right on day one.
Right.
And the accountant will say exactly what you said. Okay, well, you got to have a set of books that is just for the business. Now, okay, I drive my truck. Mm-hmm. I take it out to my landscaping job, but I also go to church on Sunday with it. So that seems kind of blurred to me.
It is. And it depends. So does the business own the truck or do you own the truck? So the business owns the truck. Well, then maybe you've got a taxable benefit for using the truck for personal times, and that'll affect your taxes. You own the truck. Well, is the business actually paying you, or are you claiming that as a tax deduction on your own taxes?
Yeah, and if I've started my own business, well, probably the truck's in my name. Like I didn't start a corporation and put it in my name. So what CRA would tell you to do is have a logbook.
Right. So keep track of all the expenses related to the truck, fuel, maintenance, insurance, whatever, and then keep track of the mileage that you're using for the truck. So Monday to Friday, I'm using it for work every day, but on the weekends, I go to the beach, the cottage, whatever. Well, how many kilometers did you use for work versus how many you used on the weekend? And that's the ratio that you're allowed to deduct for business purposes.
Yeah, and the only way to do that, the old school way, is you have a notebook in your glove box.
And you write down
you get into the truck in the morning and you put down the odometer reading is this. And then I went to this job and this job and this job. And at the end of the day, the odometer reading was that. Right. So I knew I did 72 kilometers today. Mm-hmm. You know what the odometer was at the start of the year and at the end of the year. That's how you calculate what was business and what was personal. And you're right. You've got to keep every time you fill up with gas, oil change, repairs, the lease payment. And if 60% of your driving was for business, well, then you get to deduct 60% of all the automotive expenses.
Right.
That's pretty complicated.
And it's a lot of work.
It's a lot of work. Now, I'm sure there's an app on your phone that'll do that now for you.
Sure.
I'm not in. I don't know what the kids are doing now, but that's
don't
how
have trucks.
That's true. They don't drive.
That's right.
That'd be another show.
It's landscaping. They show you a picture of what it would look like if you spent the money.
And we use AI to do it for you. So that's pretty complicated stuff.
Right.
And this is why I say you got to sit down with somebody who understands this first. Because you get to the end of the first year and you go to file your taxes and they go, where's all your, I don't even keep track of any of that.
Well, worse, you get to the end of the first year, you file your taxes and you didn't set aside any money.
Yep.
And so it's, okay, now I'm afraid to file my taxes, and that's a snowball that
then it becomes year 2 and year 3, and then you're talking to us. So at the very least, you want to have a separate bank account for the business, even if the business isn't incorporated.
Correct.
It's just, Doug's Landscaping, I'm a sole proprietor. All the business stuff goes through that bank account, and that way at least I've got a separate set of records for everything.
Right.
Okay, here's the third problem I see with all this.
Mm-hmm.
It can screw up your credit score.
And it could easily do that a couple of different ways. So the first way it impacts it is your credit score is based in part on your utilization rate. How much of your available credit are you using? So it's been turned into debt every month. Well, if you're now financing your business using personal debt, that utilization rate is probably shooting up, which means your credit score is going down.
And so when you try to live your personal life, like, hey, we want to buy a house, no, you can't.
Well, or they'll let you, but it's going to cost you more now because your score's lower.
Or I need a car.
Mm-hmm.
Okay, I've got the truck for the business. That's fine, but that's not very practical for other stuff I'm doing. I can't. My credit score is such that, as you said, my utilization is so high because I financed the business.
They won't approve you for anything.
They won't approve it. So you got to kind of look at all the different factors here. So so financing it yourself is good because you've probably got better access to credit as a individual.
It's easy and it's fast,
but it's fraught with peril.
It is.
If you don't pay it back, you're on the hook for it. Now you've got the blurring of the finances, and it may impact your ability to borrow in the future.
And it's well documented, folks, that most new businesses fail somewhere around year 3 or 4.
Yeah, and it's like 80% or something. It's a significant percentage.
It's because none of this stuff was planned out. And it may be that the business was forced on you in the first place. You lost your job. You got to do something tomorrow because you got rent to pay next month. But all of these cases, well, again, 80% of these cases that end in disaster.
Yeah, and well, let's get into the practical advice as to how to avoid the disaster then.
Right.
I think like there's many reasons why businesses fail. One of them is they're undercapitalized.
Right.
And I don't know if that's the main reason.
I think that's the single most common reason. Either they're carrying too much debt to get the thing started in the first place, or more likely, they just don't have enough cash flow to survive your personal expenses while you're building your profits in the business.
Yeah, because I remember, and you remember this too, when we worked for the big accounting firms. So the way accounting firms work is they charge you out by the hour. Mm-hmm. So you work on a job, and back in those days, we had timesheets we filled out with a pen. I'm sure it's electronic now. And at the end of it, I go, So this year I had 2,000 chargeable hours, and you're charging me out at $100 an hour.
It might have been when you started.
It was, I think. This was 38 years ago. 38 years ago. So, because I started when I was 10. And I'd think, wait a minute, you're not paying me $200,000. You're not even paying me $100,000. You're not even paying me $50,000.
Where'd this money go?
Where's this money going? So it's like, I can do this myself. And of course, you and I did.
But remember, the first year we were in business, we made $6,000 for our T4 slip.
Yeah,
right?
That's right.
The second year, I think it was $15,000.
Yeah.
So we had to have enough money to carry our personal expenses for those 2 years.
Yes, because at the time, so we started this business in January of 1999. My first kid was born in March of 98, and my second kid was born at the end of 99.
What were you thinking?
What the hell is that? Well, because life goes on.
Right.
It's not like, well, I guess I'll wait till I'm 60 to start a family. So, yeah, obviously with...
I think I was 50.
There you go. Hey, wait a minute. Mathematically, that can't possibly be true. But there were significant costs. And so you're right. You and I were not able to draw really anything from the business.
Well, and the nature of our business was such that you can't take any money out in the first couple of years anyway. So it was all, if we hadn't had a plan in place, it would have been bad.
Yeah. And we were able to borrow some money.
Through the business.
I had a buddy at the bank who said, okay, we'll give you a loan. And I think a year later, the bank said, why did we give you this loan? What were we thinking?
Too late now. We've got it.
Yep. Sorry, guys.
See ya.
And so, yes, we had a plan, but it also meant personally, we were spending as little money as possible.
Right. And we had to guarantee that business debt. And
even to this day, our names are still on whatever borrowing we do. So I agree. I think the biggest problem is you don't anticipate what it's going to cost. You think that no problem, I'll generate clients, they'll be paying me, everything will be great. So you got to ask yourself, what happens if I don't generate the clients I thought I was going to generate? And what happens if it takes longer for them to pay? And what happens if my expenses are higher than I thought they're going to be? Right. All of those things are going to happen.
Yep.
And so if you think you need $50,000 to start your business, you probably need $200,000.
Yeah. More, certainly.
You need more.
Yep.
And that's what gets you into trouble. Now, if you are undercapitalized and you can't raise the money, your only option is you got to keep your expenses as low as possible.
Right.
So in this fictional landscaping business, it's like, well, I'm not going to buy that excavator. I'm going to rent it per job.
Right.
Okay, I need it for 3 days. I'll rent it. It's going to cost me more, but I only need it for 3 days. And you've got to be making decisions like that. Obviously, in our business, as the owners, is like, well, for the first 10 years, we were doing pretty much all the work.
Right.
We had some staff, but it's like, well.
And not getting paid.
Yeah. And I think in our case, it did take about 10 years before we got to buy these fancy clothes
You mean this company jacket I'm wearing?
That's right. Which is tax deductible.
Which I always wear.
I guess the sponsor of our pod, we finally found the sponsor. It's us.
Ourselves.
Okay. So practical advice. Number one. Separate accounts and bookkeeping. Even if you're using personal credit, you got to track the business versus personal carefully. I think we've already talked about that.
Yep.
And there's many nuances to that, but you just got to do it. It's kind of as simple as that. Consider secured business loans, microloans, or government-backed financing where possible. Okay, I think we've already talked about that as well.
Right.
Easier said than done.
But there are government programs for young people starting businesses, for new Canadians starting businesses. So there's access to some money where it might be less expensive than taking on personal debt.
And I have some experience in this area because I have some other business
You were
interests.
both a young person and a new Canadian?
Exactly. Well, when I was born, I guess I was a new Canadian. No, I was never a young person, sadly. I was born an old man. So I have some investments in other businesses other than this podcast empire, which of course is the leading one in our industry. And we have in these other businesses, these are kind of tech focused, things like that. We've gone to the government agencies, BDC and EDC and a bunch of those. And yes, they do have money. And if you fit right into that specific niche, then you can get money, and it's probably going to take a year.
Just to figure out the paperwork.
Because you got to figure the back and forth, and the blah, blah. So I would not be basing my business on being able to get government financing. unless you've got somebody who really knows how to navigate all that.
Right.
Because it'll take longer and
Yep.
it'd be a lot more complicated than what you thought. Number 3 on our practical advice thing. Talk to an LIT if debt becomes unmanageable. A consumer proposal can deal with personally guaranteed debt. Okay, that's obviously a shameless plug for licensed insolvency trustees such as ourselves.
Right.
It's not as easy as that, though. If I've got a business, I can't just be going bankrupt.
Well, so the issue is this. When you file a proposal to creditors, you're saying, I can afford to repay part of what I owe you. That part is contingent on, well, if we just shut you down through a bankruptcy, what would we get? So when you've got this new business, one of the tricks is, how do you value the business? Have you got a recurring customer list? Are you showing profits? I mean, the place that a proposal can really benefit you is that it can relieve the stress of those monthly payments when you have overextended yourself at the start of a business. But you're confident that the business is going to grow over time, and so that there will be funds available.
The problem is, if you file a consumer proposal, then you lose pretty much all the access to credit.
Right.
So you better be on a cash flow sustaining basis at that point. Second problem with a consumer proposal is, by definition, your debts can only be $250,000,
right,
excluding the mortgage on your principal residence. So if you have financing on 3 big trucks,
you're out of luck.
You're out of luck. Now, you could file a Division 1 proposal. There's other ways to do it, but it's not quite as simple as it may sound. So my advice on that is, I don't know what you should do. You got to come and talk to an LIT.
Right.
And the first thing we're going to say is, well, is the business cash flow positive yet?
Does it actually make sense to keep this business running? Is it viable?
Right. Because if it isn't viable, then the first answer is, well, I guess the business closes.
Right. Plan B.
And like you said, the vast majority of businesses don't survive the first 5 years.
Right.
So that's kind of how it is.
It just happens.
It just happens. Maybe you mistimed the market. We talked to lots of people who started a business at the end of 2019.
Oops.
And totally not their fault. They did everything right. They had and it didn't work. You know,
the world was put on hold.
Yep. Operating a hair salon in 2020 was not a great business option. So sometimes it just happens. Okay. Now I'm going to give you the answer to this whole issue.
Okay.
This is the big secret of business, and
marry rich.
That is the
win the lottery.
Right there.
What are your answers here?
Any one of those things works great. Here is the secret to business. And I learned this from a guy I worked for at the big firm many years ago. So Blair, if you're watching, thank you very much for this. In order to be successful, you need at least 3 things: a maker, a seller, and a scorekeeper.
Okay.
That's the secret to business. You are probably at least one of those things.
One would hope.
So in your roofing business that you operate on the side,
yep,
you're really good at climbing up on a roof and hammering in the nails. And
when I say I got shingles, I don't mean the disease.
Yeah.
Right.
Ted has shingles. So if you're starting a business, you probably know how to do that thing.
Right. There's something that you are good at.
Right. And you've got some experience, and maybe you got some contacts and everything. But you also need to be able to sell it.
Right.
Totally different than being able to do it.
Yep. Got a fabulous mechanic that works on some of my older cars, but he can't find clients for boo.
Yeah, he's not a salesperson.
Right.
And when you and I started this business, we were good accountants, I think. You know, we understood the rules and everything. Were we the best salesmen in the world? I don't know.
Right.
We didn't have a podcast 28 years ago. I know that for sure. So how are you going to generate the clients? Just because you're good, no, people will not flock to your door. And then the third thing is you got to be a scorekeeper, which of course is the accounting function.
Somebody's got to do the math, because you could be doing fabulous sales. You could be churning out all kinds of product or service, but if you're not making money at it, what's the point?
I'm going to make it up on volume. That's how Amazon and cable companies and all the rest of it. Well, if it costs you $110 for every $100 you bring in revenue,
you shouldn't be in business.
You got a problem. And unless you've got somebody who's keeping track of all that, you're kind of toast. Now, I think there's actually a fourth thing. You need a maker, a seller, a scorekeeper. I think you also need a visionary, someone who can go, well, where's the world going? What's going to happen? And is that horseshoe business really going to have long-term potential? Or maybe I should be thinking about something else. Buggy whips. If you don't have those things, then you are going to have problems.
Right.
It's
the likelihood of failure is significantly higher.
Yes. And so what you've got to do is either hire those resources or partner up with someone who knows how to do it.
Right.
And I mean, you and I are different people.
Mm-hmm.
I'm obviously the good looking one. I think
there you go.
Everybody on this podcast.
We both have a face for radio.
Exactly.
Mm-hmm.
So, but you know, you got to find someone who is different than you.
Bring different strengths to the
different strengths. So if I'm an engineer, well, maybe I need a sales guy. If I'm an accountant, maybe I need a sales guy, a scorekeeper, or whatever. Right. I think if you can do that, your chances of success are a little higher. So, okay, here's my closing comment then. The biggest mistake people make when not starting a business is not having a plan.
Right.
You already said that. You got to be able to plot through the cash flows. Who's going to do all the different...
and it needs to be a comprehensive plan. It can't be, I'm going to put a lawnmower in the back of my pickup truck and start cutting lawns. There's more to it than that.
Mm-hmm. Where are you getting the customers? How are you keeping track of it? How are you funding it? A whole bunch of stuff. So I would suggest that before you start your own business, it would be a good idea to chat with somebody who has started a business.
That makes sense.
And who's been successful at it or who hasn't been successful, one or the other.
Well, you learn more from your mistakes.
Yes, but get a sense. What did you do? How does it work? How many hours do you work? Because it sounds great being in business. Oh, I'm the owner. I can do whatever I want. Yeah.
Right. You can do whatever your customers want, or you won't have customers very long.
I remember in my audit days working at a very big company. Like this was many multi-millions of dollars. And the CFO, the chief financial officer, I remember coming to the office one day and he was up on a ladder at the factory cleaning out the gutters. I said, dude, like, well, you know what? They got to be done.
Right.
It's going to rain tomorrow. It's easy enough for me to get up there, clean them out. It wasn't that big a job, and I just did it. Well, okay. So if you're starting a business, do you have that same kind of mentality?
Right. Same kind of work ethic.
If you do, then you'll probably be able to figure out. So I will put links in the show notes to some of those shows that, as I said, I did with David Barnett about buying a business, starting a business, and how to kind of take the insolvency spin to it, so you can get some additional information on that.
Perfect.
Our advice is crunch the numbers first, be realistic, and make a plan. So that is our show for today. Like, subscribe, hit the notification buttons. You guys all know what to do. Thanks for listening and watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.